Craze over India's stock markets has reached a scale never seen before. Today, the country has nearly 15 crore investors. This number stood at 4 crore just 4 years back. These investors are not only based in big cities like Mumbai and Delhi but instead are coming from all parts of the country. Consider this, the growth in number of investors is higher in states like Jharkhand and Chhattisgarh than Maharashtra and Gujarat. Brokerage firms are also saying that most of their new customers are now coming from Tier 2 and 3 cities, reflecting the reach of trading in the country today. The markets have reached new heights and people have made a lot of money. The story is a fairy tale. But there is a catch. Seasoned investors are worried that people have forgotten about the risks of investing. They fear that in the rush to make money, people have put caution aside. And this can end very badly for them. Indian stock markets have been running for more than 3 decades now. Sensex and Nifty have managed to become household names and their movement every day becoming a subject of dinner table conversation. Investors' count started taking off in the last decade as the number of mobile phones and internet reach increased. Between 2014 and 2020, the number of demat accounts required for trading increased from 2 crore to 4 crore. This steady growth was attributed to increasing financial education and advertisement of trading apps. However, a rapid shift happened in 2020. Since the COVID-19 pandemic started, the number of investors saw a dramatic jump. Between 2020 and 2023, the number of investors nearly tripled from 4 crore to 11.4 crore. The pace of adding new investors was unprecedented. The markets enjoyed the amount of money flowing in. Since falling below 28,000 at the peak of COVID-19 pandemic in 2020, Sensex has reached several new heights. On March 6, it reached the 74,000 level. Common investors' money in the markets has also reached through mutual funds. The total monthly contribution of common investors crossed the Rs 19,000 crore mark for the very first time in February. But during such highs, there have been concerning signs which has worried seasoned investors and India's capital markets regulator SEBI. SEBI chairperson Madhabi Puri Buch said on March 11 that there is froth in small and mid-cap space. She said that there is need to control the situation before a serious bubble problem.
Some people call it a bubble, some may call it froth. The question is, it may not be appropriate to allow that bubble to keep building, because if it keeps building, then when it bursts, because a bubble will burst, by definition bubbles burst. So when they burst, they impact the investors adversely.
Her words came weeks after SEBI asked mutual funds in India to moderate inflows into small and mid-cap funds to protect investors. ICICI and Kotak followed the call and imposed restrictions on flows into such schemes. After the concerns were raised by SEBI, there was a bloodbath on the markets. The small cap index shed over 4,000 points within days. Experts said that the intervention was necessary as they felt new traders don't always understand fundamentals of companies and put money into any stock based on hype. This resulted in irrational rallies. Outlook Business Analysis showed that the average valuation multiple of 512 small-cap companies nearly doubled between December 2019 and 2023. This must have worried India's regulator and it stepped in to protect the market. But this is not the only area which has confused observers. There is another, more dangerous segment, seeing new young investors dabble for money. India has a futures and options trading space, where investors can speculate on prices of stocks and indices. This is supposed to be a space where experienced investors trade to hedge their bets. The method is instead of being used by new investors looking for astronomical returns, akin to gambling. The number of individual investors rose from just 7 lakh to over 45 lakh in the segment between the financial years 2019 and 2022. The more worrying part is, 9 out of 10 investors in this segment are making losses. And yet they continue to trade here in hopes to be that one winner. When the market cycle changes, these delirious investors will learn a hard lesson. With so many spread across India, the cost of a big stock market crash can be higher this time around. It remains to be seen how ready these new investors are when things turn sour. For a detailed analysis, read Outlook Business Magazine's April issue cover story. Like, subscribe and click the bell icon for more such insightful videos.